I think Spain has been through deeper structural reform than the other southern European markets, and I think the impact of that was visible pre-crisis, and the impact of it is still visible post-crisis, in particular in the speed of turnaround in the Spanish market. I think also very, very significantly, and I'll say, although I'm not a particular fan of the model, the Spanish resolution of the banking crisis has moved faster than it has in any of the other southern European markets. And all the other southern European markets, to a less degree Portugal, but I'll say all of them, have a moribund banking system right now and are still net credit contractionary to the private sector. And whereas Spain has an effective mechanism for credit transmission. What I mean by that is there's money available for people to buy real estate. And I think that's been very, very important in the evolution of the Spanish market. It's been very important in the evolution of confidence in the Spanish market. And all things considered, the answer should be yes, Spain will continue to perform like that because everyone else is still grappling with the basics of structural reform and the banking system issues. The big but being Spanish politics. And I'll jump to a question I'm sure you're going to ask me at the end, which is where would I invest my money? And the answer is Spain's interesting if you see political stabilization. But right now, I think there's a very binary outcome. If you see the wrong political outcomes, Spain will go the wrong way. If you see stabilization politically, I think Spain will continue to outperform.
At the time being, the Spanish market is completely stabilized from the usual shopping center, office, acquisition perspective, easy access to financing, significant demand. Most of the actives are liquid, at least if you price them at the right price. And there is a significant amount of money, both international, mainly focused on retail, and national, focused on offices. So I think we're starting to get into a sort of stabilization of the property market. We're still lacking the recovery from rents, both in shopping centres, because we haven't seen the consumption crystallizing in increasing rents, and we haven't seen employment crystallizing in increasing rents for office spaces. But quite a significant amount of investors are discounting, at least in offices, this rental growth. So it's a tight market in terms of yields.
And just to give us a flavour of that, in terms of, let's say, the shift that there's been in rent, I mean, I guess within the last 5 or 8 years or whatever, what was the peak of the market and where are we now?
For example, in Madrid, the market peaked at around 42 euros per square meter, which is we're right now super highest lettings that we've got this year are in the region of 31, 32. And that's for small spaces in very particular office locations. If you think about an average for prime CBD, we're probably around 28. So we've still got 50% upwards to get to big levels. So it's a big gap. If you move to secondary locations, the gap is even bigger. Certain locations got to 24, 22 in out of town. We're probably talking about 15, 14, 16 euros for the best locations in out of town offices in Madrid.
Okay, so if we buy into Bill's scenario that if the politics work and things move, then there's potentially quite a lot of rental growth that you could see.
The significant gap in between 2008 and today.